Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. Now today on the show, we break down a new report on gold and what it means for investors. Geopolitical tensions like, of course, the ongoing Russia-Ukraine conflict and the recent conflicts in the Middle East have rattled markets and sent shockwaves through global supply chains. And inflation rates remain a concern, with the U.S. inflation rate still quite high and similar pressures seen globally. All this while central banks around the world have been amassing gold reserves at an unprecedented rate, with the purchases by central banks reaching a 55-year high in 2023, totaling over 1,100 tons. Now, this report right here, the 2024 edition of In Gold We Trust, explores critical topics such as the de-dollarization trends, with countries like China and Russia significantly increasing gold holdings, the potential for gold in a high inflation environment, and additionally, the report touches on emerging trends such as the BRICS Plus expansion and the implications for global trade and the currency reserves. Now, to help us make sense of all of this, including myself, and what, of course, it means for investors, we have Ronnie Stoeferle. Did I say it right, Ronnie? Joining us, of course, today from Austria. Perfect. There we go. Now, Ronald is the managing partner at Incrementum AG, the fund behind this report, and of course, he's also the co-author. Hey, Ronnie, I haven't seen you since Vancouver, my friend. Welcome back to the show. Good to see you again.
Thanks for having me, Jeremy, and thanks for not butchering my last name. You did tremendously well.
I'm trying to make sure that, you know, my German relatives understand that I can at least speak a little bit of this. Okay, let's break it down here. Let's talk about the big report, In Gold We Trust. Ronnie, we talked about it back in January. We've been waiting quite a while for it. I know it, you know, you put pen to paper for quite a while. And of course, it comes as we see major geopolitical and economic changes. Of course, I mentioned Russia-Ukraine conflict, you know, rising inflation worldwide. I'm curious, before we go into it, though, what are you seeing in the market right now? Is this trend real? And what are you trying to highlight in the report? Give us a little lay of the land, if you could.
Well, Jeremy, I think that first of all, I think it's crucial to understand that we're now in a new stage of this gold bull market. What we're seeing in markets is classic early bull market action. We are seeing that miners are really leading the price of gold. They're outperforming gold. We're seeing that silver is outperforming gold. We've seen that the gold-silver ratio, for example, broke a trend line to the downside and is now trading at the 52-week low. We're seeing that commodities really start performing well, not only copper, but also some agricultural commodities. So it seems really that we're in a new stage of this bull market. Now, I had a look at the chart before, and you know, last year's In Gold We Trust report was called Showdown, and we said there will at some point be a showdown in the price of gold, because we've been flirting with this $2,000 very important from a psychological point of view price level for quite a while. Actually, the price of gold was consolidating for almost 4 years in that price range, and now we finally broke out of that range. Now, if you have a look, for example, at the previous big bull market, and when it moved to another stage of the bull market, you can tell that, well, actually, the $1,000 range or this critical level, we reached at first in January 2008, and then we tested it a couple of times, and then only in September 2009 we really broke out. And then we've seen an impulsive move up to almost $2,000 within basically 2 years. And now it seems that we're seeing something similar, but at a larger scale probably. So it took 4 years for this consolidation pattern to actually get resolved. And now we are really moving into an impulsive move that is clearly also being led by CTAs, by managed futures, by momentum players. We're seeing that the Western world actually hasn't joined the gold party yet. Yeah. So lots of moving parts, and we try to explain the most important factors for the price of gold in our report this year. 440 pages, so it's a pretty extensive read, as always.
It is, but it's a good read. And you know, I have the compact version here in my hands, And there's some really interesting ones. But Ronnie, obviously we've seen what's been happening in the world. We saw after COVID, we got inflation kind of setting up the perfect storm for gold. But what's surprising you here?
Well, I think the surprising thing actually is that the price of gold doesn't act like in the old playbook. And this is the leitmotif of this year's report. I sat together with the team. There are 20 people working on this report. It's not just me writing this piece, obviously. But we sat together with the team and said, well, actually, real interest rates are surging. We're seeing that inflation is coming down while interest rates are going up. This actually should be a pretty negative environment for the price of gold, but still it's holding up so well. Then we're seeing that the Western world is still experiencing outflows when it comes to ETFs. Just last year we saw 280 tons of outflows from the ETFs, primarily from the Western world. So we said, okay, a good coach in sports, be it American football, hockey, or soccer, my favorite sport, you have to adapt your playbook. You have to modify it according, to the strengths and weaknesses of your opponent, according to the general environment of the playground, but also to your own strengths and weaknesses. And so we said, okay, actually, it seems that there is a new playbook in the gold market, which is primarily being dominated by the enormous gold demand coming from emerging markets. This is a trend that we're explaining for a while, but I think that's really the most important drivers. I think the marginal gold buyer isn't in the Western world anymore, and therefore, I think we in the Western world should realize that the price of gold isn't primarily being influenced by London, New York, and Zurich anymore, but rather by Dubai, which is 25% of all gold trade, Shanghai and Mumbai. I think, therefore, for us, it's much more important to really analyze demand drivers in those countries.
Yeah. You talked a little bit about the East versus West. We've heard lots of narrative about this. We've also talked about it. And you've talked a lot about de-dollarization, with countries like China, Russia boosting their gold reserves. Many experts think that the U.S. dollar dominance is too strong to be seriously challenged. But are we overestimating this shift?
Well, I think before the de-dollarization, there's going to be a de-euroization. I think that the dollar is still clearly how do you say, the least dirty shirt in the laundry, basically. We've got a fascinating discussion between Louis Vicent Gave and Brent Johnson, Mr. Milkshake, in this year's report, and both are making great cases for de-dollarization, but also for dollarization. And I think it's important to say that, first of all, this is a really long-term trend. Does gold play a major role in this de-dollarization story? I think yes, but sometimes it's a little bit overestimated. But just some numbers. The renminbi, for example, the renminbi share of global trade settlement, historically it was roughly 1%. In September 2023, it rose to 4.6%. So basically up significantly, and it seems that we will be going to 5% over the course of this year. So it is a move. It is still tiny compared to the US dollar. But then, of course, China is facilitating the internationalization of the renminbi via the Belt and Road Initiative, which now includes 150 countries and 30 international organizations. There were like 200 cooperation agreements being made just in the last 2 years. Then we're seeing, obviously, that the relationship between China and Russia is getting closer and closer. It's no coincidence that the very first trip abroad after the re-election of Vladimir Putin he went straight to China, and the images that were transported with this kind of awkward hug between Xi Jinping and Vladimir Putin. I think that clearly shows what's going on. China is by far the largest gold producer. It's now the largest gold consumer. Russia is a significant player, both on the production side, but also on the consumption side. So it is obvious that I would say like the emerging markets in general being like the small brother that is growing up, and it's getting stronger and stronger, but it's not being taken serious by the big brother. And I think the Western world at some point will have to realize that the smaller brother has grown up, is getting stronger and stronger. This is the region where the growth is, where favorable demographics are, where there's in general lower debt, with the exemption of China, obviously. And it's also a region that is has a traditional gold affinity. So China and India alone are responsible for more than 50% of all gold demand. If you put in the Arabic countries, if you put in Turkey, Russia, you end up with 2/3 up to almost 70% of all gold demand coming from those countries. And it's not only gold demand, but also the majority of gold production. So I would say, to answer your question, de-dollarization is a topic. It's a process. We're seeing this politicization, I would say, of gold. It's no coincidence that, after the invasion of Ukraine, and what followed, obviously, the Western world basically saying with the stroke of a pen that the Russian currency reserves are worthless. It's no coincidence that since then, central bank demand has tripled. So I think this is really one of the major long-term drivers of the price of gold. I would say that central banks really have put in a floor under the gold price.
Yeah, absolutely. Some say that this could be a strategy to undermine the U.S. dollar. Do you think that there's a bit of a hidden agenda here, or do you think that, America is just not watching closely enough?
I wouldn't underestimate Americans and American politics. I think it's something that's pretty obvious. The question is if they can do anything about it. And it's also, it's like in the conversation that we have in the report, we say it's basically like a divorce that we're seeing between the Western world and kind of the emerging markets. And of course, there are some countries in between, but it's like with every divorce, there's basically only losers, and in between there are often the kids that suffer the most. So I would say it doesn't have to be a really nasty divorce, but I don't see really anybody winning in such a divorce. The big question is how long it's gonna take. Louis St. Gav makes a brilliant analogy where he says that the US dollar is like Microsoft Windows, where everybody's complaining about Windows, but still it is by far the most important operating system. And if we would switch to another system, it would be costly. It would take quite a long time. And then actually the new system would have to be 10x better. So currencies are network goods, like languages are network goods. And the global reserve currency is obviously also a network good. So therefore, I don't think that a fiat currency will actually replace the US dollar as the world premier currency. I think it's going to be at some point there will be some sort of a reorganization of our currency system, and that sounds like something dramatic. But if you study history, and I've got so many history books, especially about historic episodes of currency reforms and hyperinflation, it's just something that happens every couple of decades. So and the gold always played a major role. So it's no coincidence that the major players, US holds more than 8,000 tons of gold. The Eurosystem holds 12,000 tons of gold. The IMF holds 3,300 tons. And the emerging markets are buying gold like crazy. So
Yeah.
I think that gold within this big picture reorganization of the world currency reserve will play a major role, and everybody's preparing for that.
Yeah, Ronnie, I mean, it's been such an incredible, I was going to say incrementum, and it kind of is, but an incredible thing to watch. But, the report mentions that there's a gold image problem in the West, where it's often seen as a little bit outdated. The younger investors missing out on gold's value. Is it because of this perception? How can gold compete with the appeal of tech stocks and these modern investments that we're starting to see, even on the Bitcoin side?
Yeah, well, actually, if you just have a look at the performance numbers of
Yeah.
gold, I mean, in US dollar terms, we're up 13% this year. We're up 12% last year. In euro terms, we're up 15% year to date. In Japanese yen terms, we're up 26% year to date. We were up 21% last year. So if you just have a look at the performance numbers, it's pretty obvious that the price of gold did tremendously well. It's by far the hardest currency, the strongest currency. But from my point of view, it's not the price of gold that is rising. It is rather the purchasing power of fiat currencies that is just falling at a faster pace now. And it's Jeremy, it's not only the price of gold rising nowadays. It's also of course equities. It's, as I've said previously, it's commodities. It's Bitcoin, obviously. So we're seeing some sort of we call it a debondization, or Bank of America called it ABB, anything but bonds. I think this is really the elephant in the room. Investors realizing that inflation is actually quite sticky, and that perhaps a second inflation wave could already be building up, and then obviously you would prefer holding gold, commodities, and equities over bonds. So this is one part of the story, and I think the topic that you mentioned, this kind of image or marketing problem of gold in the Western world, I think this is really important for us also in the Western gold world, because first of all, this is something that is only being experienced in the Western world. So if you like gold, you're in Germany, for example, there was on national German TV where kind of a comedian said that if you're buying gold, you're a Nazi. Then obviously
So the branding isn't good. That's kind of the question, because
the
if
narrative, I would say. Yes.
Yeah, like if central banks are so bullish on gold, why isn't there more evidence in the public financial strategies? I mean, could there be a political motive at play beyond just the economic reasons here?
Yeah, obviously. I mean, first of all, I think that the narrative is kind of that that gold is only an investment for those diehard gold bugs that kind of hope that the world is ending up with a third world war, hyperinflation, whatever. The second very, very important narrative these days is that gold is useless and it's not green. I always it makes me smile when people say, copper is so much greener than gold. I think most of those people saying that have never visited a gold mine, actually. But those are important and very powerful narratives. So for us, it's always important to make a positive case for gold. It's important to basically say, well, gold makes a difference from a portfolio point of view. And gold is a low beta emerging market play, actually, because this structural gold demand coming from emerging markets is actually much, much more important than this, let's say, gloom and doom demand from the Western world. So this is really, really crucial. And it's not only gold itself, but it's also the mining space that has a really, really poor recognition these days, which is interesting, because actually, for you know, the green energies and the green reform, or whatever you want to call it. Actually, we need enormous amounts of commodities, enormous amounts of metals. But then on the other hand, nobody wants to work in that area. So it doesn't
It's
really add up.
wild.
Yes.
It is a little bit of a supply and demand deficit for sure. I mean, when we talk about the report, asteroid mining, deep sea mining sounds like science fiction, but you kind of discuss them as future possibilities. And I'm curious, when you start to look at these as really viable options, are we just kind of ignoring some concerns here? Going back to your point, if gold has kind of been branded as this dirty type metal, is that really going to help it out?
You mean deep sea mining?
Yeah,
And stuff like
yeah. I'm
that?
curious what the
Yeah.
future of
No,
this is. I got into
no.
it. It's a big section here.
Yeah, yes. I mean, I think it's super interesting, and that's what I really love about my job, and my team has done a tremendous job. Also, really, really, researching and reading all those academic studies and talking to experts in that field of asteroid mining and deep sea mining. And I think that for gold, actually, it's not gonna be the big driver because let's face
Yeah,
it,
yeah,
most companies have a hard time to make profits mining gold, on this planet. So
yeah.
if you move out of space, it's gonna be enormously costly. Um, but it is an interesting topic, and why not in 20, 30 years? Why shouldn't it become a driver? So I cannot rule it out, obviously. But then when it comes to deep sea mining, I think it could become a driver for many minerals. I would say not so much for gold. Um, but there's lots of initiatives, and also actually in capital markets there's really interesting developments. Um, it is, of course, a very sensitive topic when it comes to the whole ecosystem, but there's quite a lot of things going on, and I think it's really important to make to really communicate that the mining sector has done a tremendous job in the last couple of years, really, addressing those ESG concerns.
Mhm.
So yeah, I think it's one of my favorite chapters. So it's asteroid mining and deep sea mining. Is it science fiction, or is it really the next wave of innovation in the mining space? So we try
Yeah.
to discuss that topic.
Yeah, and I mean, some even thought that gold sitting around these a while ago was not going to be believable either. Speaking of which, you had a gold forecast of reaching about $4,800. That's $4,800, I should say, by 2030. It seems ambitious. Critics might say a little bit, too optimistic. What makes you confident here, Ronnie? Talk to me a little bit about the projection.
Yeah, well, actually, Jeremy, we put out that model, which is based on the growth of monetary aggregates. We put it out
Yeah.
in the In Gold We Trust report 2020 and said 4,800 US dollars. That's our long-term price target for the end of this decade. Now, 4,800 bucks sounds quite spectacular, but then on the other hand, that's like 12% CAGR for the next couple of years until
Mm.
2030. Now, from my point of view, that sounds pretty realistic, and let's face it, the price of gold was trading at 1820 end of October last year. Now we're above 2,300 bucks. So it can move really quickly. But the most important thing is, um, as I've said before, the Western world um, hasn't really joined this party.
Mhm.
We're quoting a couple of studies, for example, by Bank of America, that actually said 71% of all investment advisors in the United States are recommending between 0 and 1% gold allocation.
Wow.
Now, um, our model, and we come up with a new 60/40 portfolio. Um, we're quoting quite a lot of academic studies, and then we also have made our own models, and we say that the gold allocation in your portfolio should be between 14 to 18%. Now, at the end of the 1970s, if you would have said a gold allocation of, let's say, 15%, people would have ridiculed you because it's just too low.
Right.
And now people ridicule you because it's way too high. It's really outrageous. But I think it's important that the emerging markets, as I've said before, they have already joined this party, not only in China and India, but also, Turkey, Russia, the Arabic world. The Western world hasn't joined yet. And I would say, like, most of the media contacts that I have, they tell me, well, gold is already too expensive. Should I sell now? But Jeremy, there wouldn't be a case for sound money. There wouldn't be a case for gold, but also for Bitcoin, if we would have a sound monetary system. If inflation wasn't a topic. If that wouldn't be a big topic. But just Lynn Alden had that previously in one of her newsletters. So she's quoting the CBO forecast. So in the next 10 years, according to the CBO, if no recession happens in the next 10 years, which is, pretty optimistic, I would say, we will see 20 trillion of additional debt in the United States. Yeah, 20 trillion. If you say, well, the gold supply will grow with the average rate that we've seen over the last 120 years, that would mean at current prices we will see at current prices 3.2 trillion new gold coming to the market, which is it's kind of limited by the geology. When it comes to Bitcoin, for example, it's predetermined by the algorithm, by the code. We'll see over the next 10 years, a little bit more than 1 million new Bitcoins coming into the market. So what I want to say, it's really all about relative supply curves. And I think that, Western financial investors, their assumption, also having a look at the development of real interest rates, their assumption is, well, actually, inflation is under control. We will not see a recession going forward. So we moved from, hard landing to soft landing to Goldilocks, and now it's never session. That's like the big topic out there. And I would say that some sort of a stagflationary environment actually is more realistic than ever. Also in the United States, we're experiencing that in Europe, big time. But I think, without this enormous fiscal stimulus that we've seen in the US, 8% budget deficit in a year of full employment. That's like drinking 4 Red Bulls and 7 cups of coffee when you're tired. Of course, there is an effect, but is it really healthy for your your long-term picture? I think it's not. So therefore, I think the recession is kind of it's postponed. We've got an election year obviously coming up, but I would say once we hit the recession, once the next wave of inflation is coming up, then I think that's really the point in time when central bankers, or when the Western world realizes that the emperor has no clothes, because stagflation is actually by far the worst environment for Jay Powell. And I think that really could shift more interest on the gold space in the Western world.
Yeah, it could be fascinating to watch, too. Before I let you go here, Ronnie, because it always goes so fast when I talk to you, I'm curious, talk to me a little bit just to the investors here that watch, because, we all know gold as a community quite a bit as a Kitco audience, but you're making some really good points here, and you're talking a little bit more about that portfolio, that 40-60. So as we continue to watch this narrative unfold, and as we continue to watch what's happening in the U.S. economy, albeit around the world, what do you advise here? What are the practical steps to protect the assets and maximize the returns for investors here? Yeah,
well, actually, I think, Jeremy, it's important. We're not, only gold analysts, gold writers, whatever.
Yeah.
Primarily, we're asset managers. Yeah. So we are managing 7 investment funds. Most of them, I would say, are in the gold, in the mining, and in the commodities space. Um, so therefore, I mean, we can make bold forecasts, but then actually, we publish daily NAVs, and our investors will will actually judge if we're successful or not.
Right.
But I think, if we try to understand the long-term picture, um, the 60/40 portfolio was basically that was like the standard portfolio. Let's put it that way, which was heavily influenced by the Great Moderation. So basically, 40 years of falling interest rates, 40 years of falling inflation rates, 40 years of pretty low macro volatility. So for most of the investment advisors in the Western world, inflation actually wasn't a concern at all. So, for portfolio construction, inflation rates and inflation volatility wasn't really a characteristic that was really essential for structuring a portfolio. And that's also a major difference compared to emerging markets. If you talk to investors, for example, in Turkey, I've held a presentation in Istanbul once, and they asked by far the best questions because they know how important gold is from a portfolio point of view. Why do they know that? Because inflation has always been a primary concern for them. So in the Western world, we are still heavily influenced by this Great Moderation. Our core thesis has been over the last 2 years that primarily due to this fiscal dominance that we're seeing. So we should focus more on what the fiscal side does and less on what central banks are doing. Our thesis has been that the Great Moderation is over, that we should prepare for more inflation volatility, and therefore I think it makes sense to reconsider the 60/40 portfolio. And from my point of view, it's people in the gold world often think that stocks, that equities are like the enemy. I don't think so. I think that in some sectors, especially US tech, of course it's not cheaply valued, but I'm seeing tremendous bargains in emerging markets, also in Europe, in the commodity space and so on. So our allocation, and this is like kind of a standard portfolio, would be 45% stocks and 15% bonds instead of 40% bonds. And then we advise 15% safe haven gold, which is really something that where you should care about, storing it safely, perhaps outside of the banking system, outside of your jurisdiction, really in a safe jurisdiction. Then 10% performance gold, which is silver, but also mining equities. So we make a strong case for mining equities as something that should be actively timed. And we introduce our proprietary Incrementum active aurum signal that switched to a long position in mining stocks in December 2023. And then we recommend 10% in commodities and 5% in Bitcoin. So this would be our kind of standard allocation that should do pretty well in an environment that is heavily influenced by higher inflation volatility. We're so far away from that view when we talk to institutional players that we think, okay, we're still pretty early in this game, probably like the second or third inning, probably. So this is probably an allocation that we will continue to describe in our reports. But as I've said before, it's important to always consider and reconsider and rewrite your playbook. And therefore, it was important for us to really analyze what has changed, what are the structural and fundamental shifts in the investment world, and especially in the gold world.
Yeah, second or third inning for gold. I like it. Just incredible today, Ronnie. I really appreciate this. We could have gotten to so much more. Before I do let you go, though, I'm just curious because I asked you back in Vancouver on the mining side, we were talking a little bit about the lag of commodity prices to equities on the mining side. Any that you see some potential upside that we should just keep looking at for investors here?
What do you mean in the gold mining? On the gold mining?
Yeah, that just hasn't caught up yet. Any that have some, we've seen some good lifts, but any that might just be a good little one to give off right now?
You mean a you mean a name that I want to mention?
It's exactly what I'm putting you on the spot for.
No, I think our compliance officer wouldn't appreciate that. But I think Jeremy, we launched a new gold mining or a new active gold fund on 15th of February, and actually journalists called me up and said, "Are you out of your mind launching a fund? When everything is basically in the dumps." And I would say that there's still an enormous amount of catch-up potential in the mining space, and you probably know Naval Ravikant. He said, "Be right when everyone else is wrong at scale." And I think that, this is a perfect summary. We are seeing this year that most of the producers, they will become free cash flow monsters. We're seeing that over the last couple of years, they did a tremendous job really strengthening their balance sheets. We're seeing in the silver space, obviously, silver now has started outperforming gold big time. We're seeing some decent volume coming in the silver space, but then on the other hand, generalists haven't joined the party yet. This will happen at some point. I'm pretty confident that it's going to happen. Our proprietary Incrementum Active Aurum signal would be suggesting that we are also in the mining space still pretty early on. Of course, we can see drawdowns. We've seen a pretty significant move over the last couple of weeks. But again, I think, this is early bull market behavior that we're seeing because the mining space only recently has started outperforming gold. Silver only recently started outperforming gold. So this is what you want to see in the early stages of a bull market. Now it's happening, and it's just, what should you do in a bull market? Buy the dips, as easy as that.
Yeah, well said. Well said. Ronnie Stoeferle, did I say it right? Ronnie, thank you for coming.
That was perfect.
Joining us, of course, from Austria, partner at the Incrementum Fund, and also co-author of the new Gold Playbook. Of course, we'll put a link to where you can find that. Ronnie, thanks for your time today. I appreciate that. Some great insight here.
Thank you very much, Jeremy. Really appreciate it. And you did tremendously well saying my name, so I appreciate that. Thanks a lot.
I'll take it. I'll take it, mate. We'll see you in Germany next time. Thanks again. Appreciate it.
Take care.
I'm Jeremy Szafron. For all of us here at Kitco News, we appreciate you taking the time to watch. Don't forget to subscribe. We're going to have some great content coming up. Stay tuned. We'll see you next time.